Welcome back to EcoBiz Academy and the Complete Accounting course. In Chapter 1, we learn the foundation of accounting, the double entry system, debit and credit, and how transactions affect different accounts.
And now we're moving one step forward.
Exactly. Today we're looking at the books of prime entry.
Which sounds complicated.
The name sounds worse than the idea. A book of prime entry is simply a book where certain transactions are first recorded before they're entered into the ledger.
So we're basically looking at the first stop for a transaction.
Exactly. Let's get into it.
So why do we need them?
Imagine a business making hundreds of transactions every day. It wouldn't be practical to immediately put every transaction directly into individual ledger accounts. Instead, transactions are first recorded in appropriate books of prime entry.
And different books are used for different types of transactions.
Correct. For example, credit purchases are recorded in the purchases journal, while credit sales are recorded in the sales journal. Other transactions have their own appropriate books. Let's start with credit purchases. Suppose a business buys goods for resale from alpha traders for $2,000 on credit.
The business receives the goods but doesn't pay immediately.
Correct. So the transaction is a credit purchase. It is first recorded in the purchases journal.
And eventually the transaction will be posted to the ledger.
Yes. The purchases journal provides a record of these credit purchases before the totals are transferred to the appropriate ledger accounts.
What about the opposite? Suppose the business sells goods worth $3,000 on credit to beta stores.
That's a credit sale. It is first recorded in the sales journal.
Oh, credit purchases journal. Credit sales journal.
Exactly. That's one of the first distinctions you should remember.
What happens if the business buys or sells for cash?
That's where the cash book becomes important. Cash and bank transactions are recorded in the cash book, so you need to distinguish between credit transactions and cash or bank transactions.
So a cash sale wouldn't go into the sales journal.
Correct. A sales journal is used for credit sales, not ordinary cash sales. Now let's talk about goods being returned. There are two possibilities. The business may return goods to a supplier, or a customer may return goods to the business.
So they're not the same thing.
Right. If the business returns goods to the supplier, this is a return outwards. If a customer returns goods to the business, this is a return inwards.
And each has its own book of prime entry.
Exactly. Returns inwards are recorded in the returns inwards journal. Returns outwards are recorded in the returns outwards journal.
Why not just reduce purchases or sales directly?
Because the business needs a clear record of goods that have been returned. For example, suppose the business purchased goods worth $1,000 on credit. Later, $200 of those goods are returned to the supplier. The return needs to be recorded separately so the business can keep track of the adjustment.
So the books of prime entry help keep the transaction trail organized.
Exactly.
We've talked about specific books for specific transactions. But what happens when a transaction doesn't fit neatly into one of those books?
That's where the general journal comes in. The general journal is used for transactions and adjustments that are not normally recorded in the other books of prime entry.
So it's not just another name for the cash book.
No, the general journal has its own purpose. It can be used for various adjustments and accounting entries that don't belong in the specialized books. Now let's focus on the cash book. The cash book records transactions involving cash and bank.
So money coming in and money going out.
Exactly. For example, cash received from a customer, cash paid to supplier, money paid for expenses, bank transactions. The cash book provides a chronological record of these movements.
Is the cash book just a book of prime entry then?
Yes, but there's something particularly useful about it. The cash book also serves as part of the double entry system because it contains accounts for cash and bank.
So it has a special role.
Exactly. It is both a book of prime entry and a ledger account for cash and bank. That's an important point to remember.
The chapter also introduces trade discount. What's that?
A trade discount is a reduction from the listed price of goods, often given by a supplier to a customer. For example, suppose goods have a listed price of $5,000, but the supplier allows a 10% trade discount. The discount is $5,000 times 10% equals $500. So the amount actually charged is $4,500.
And the trade discount isn't normally recorded separately in the accounting books.
Correct. The transaction is recorded at the net amount after the trade discount. That's an important distinction. Let's imagine a business carries out these transactions. Transaction 1. Goods purchased for $4,000 on credit.
Purchases journal.
Correct. Transaction 2. Goods sold for $6,000 on credit.
Sales journal.
Correct. Transaction 3. Goods returned to supplier.
Returns outwards journal.
Correct. Transaction 4. A customer returns goods.
Returns inwards journal.
Correct. Transaction 5. Cash received from a customer.
Cash book.
Exactly. Transaction 6. A transaction requiring a general journal entry.
General journal.
You've got it.
So the whole idea is really about organization.
Exactly. Think of the books of prime entry as different starting points for different types of transactions. Instead of throwing everything into one giant book, transactions are classified and recorded appropriately. That makes the accounting system more organized and makes later posting to the ledger much easier. Let's clear up a few common mistakes. Mistake 1. Confusing credit purchases with cash purchases. Mistake 2. Confusing credit sales with cash sales. Mistake 3. Mixing up returns inwards and returns outwards. Mistake 4. Forgetting that the cash book records cash and bank transactions. Mistake 5. Treating trade discount as a separate accounting entry.
So the key is identifying exactly what type of transaction has occurred.
Exactly.
Let's test it. A business purchases goods for resale for $2,000 on credit.
Purchases journal.
The business sells goods for $3,000 on credit.
Sales journal.
Customer returns goods worth $400.
Returns inward journal.
The business returns goods worth $500 to a supplier.
Returns outward journal.
The business receives $1,000 cash from a customer.
Cash book.
A business purchased office equipment for $2,500, but recorded the transaction incorrectly as an office expense.
General journal.
Simple enough when you see the pattern.
Exactly. Let's recap Chapter 2. Books of prime entry are used to record transactions before they are posted to the ledger. The main books we discuss include Purchases Journal, Credit Purchases, Sales Journal, Credit Sales, Returns Inward Journal, Goods Returned by Customers, Returns Outward Journal, Goods Returned to Suppliers, Cash Book, Cash and Bank Transactions, General Journal, Various transactions and adjustments not recorded elsewhere. And remember trade discount. It's deducted from the listed price, with the transaction recorded at the net amount.
Before we finish, let's see how well you've understood the chapter. Which book of prime entry would you use? 1. Goods purchased for resale on credit for $5,000. 2. Goods sold on credit for $7,000. 3. Goods returned by a customer worth $600. 4. Goods returned to a supplier worth $800. 5. $1,500 received from a customer. Pause the episode and answer them yourself.
1. Purchases journal. 2. Sales journal. 3. Returns inward journal. 4. Returns outward journal. 5. Cash book. And that brings us to the end of Chapter 2. If you found this lesson helpful, subscribe to EcoBiz Academy and leave a comment telling us which part of the chapter you found most useful.
And if you have a question, drop it in the comments. We'll see you there.
In the next chapter, we'll move on to ledger accounts and learn how transactions are recorded and organized in the ledger. See you in Chapter 3.